Hi everyone, welcome to the first video. So in this video, what I'm going to be answering is from mock paper 1, question number 1, part A, only part A for 18 marks. It's all on one page in the paper and this is it here. But before we get into the answer, I just want to look at something before some of you think I made a mistake. I haven't, I put something in here so that we can talk about it first. If you look at the question, you will see you've got trading profits and then you've got chargeable gains and then dividends and then chargeable gains again, and then qualifying chargeable payments. The reason chargeable gains is in there twice is this shows you the two different ways which the question can be presented. So the first line where it says chargeable gains, see below, if it is one of those types of questions, then the bit on indexation and the share gain, you calculate that gain and put that gain in here. The second one, where it says chargeable gains 29,400, if it says chargeable gains and a number, then you don't have to calculate it for this question. Now, in this question, we are going to do it in the bit you have been given a number there. So you are going to not have to calculate it. In this part of the question, we have that number. But this is just to show you. If you look at this straight away in the exam and it says chargeable gains, see below, that means you're going to have to calculate the number that will go into the answer. If you see chargeable gains and a number, then you don't have to calculate it at this point. There will be a separate question where you'll calculate a chargeable gain. Okay, so the first thing we need to do is, working our way through the question, build up the skeleton corporation tax calculation. So the starting point of any corporation tax calculation is the same point. It is profits. I'm just trying to see if that writing's big enough. I don't think it will be. I will increase the size from then on. But profits, if we look at the question, we have that number. We have that number. It is given to us in the question. The next line we come to, capital allowances, CAs. We do not have this number. We must calculate it. So we know that is going to become working one, and it is going to be a minus. The next part, after totaling those, will be our chargeable gains. So we have 685, we do not have capital allowances, but we do have chargeable gains, 29,400 in the question, like we said before. Next, less qualifying charitable payments. Again, that number is in the question. We are giving it as $8,450 minus. This will then total to TTP. We will add our dividends, which is in the question. And that will give us augmented profits. You'll notice that we've got all the way down corporation tax due at 19%, and so far we are only going to have to calculate one number, Everything else is numbers from the question. You can take these straight from there. This calculation is a big part of the question, and you haven't calculated anything yet. The only thing we have to calculate is our capital allowances. Now, our capital allowances, we are told in the question that there is both a main pool and a special rate pool. That means we need 3 columns. Main pool, special rate pool, the amount to claim. So we can dive straight in. We are told straight away that there are brought forward figures. Again, these are given to us in the question, just here, and it is 31,000 in the main pool, 25,000 in the special rate pool. We haven't calculated anything yet still. Now what we need to do is we need to look at the additions. Remembering we have 4 different types of addition: annual investment allowance, special first year allowance, no special first year allowance, special rate pool. So we look at the additions that we've got here, and we have plant and equipment 170,000. We have features of the building 75,000, and we have a zero emission van at 35,000. So 2 of those, the 170,000 and the 75,000, are eligible for the annual investment allowance. We have 170,000, 75,000. They come to 245,000. The maximum annual investment allowance we can claim is 200, and that leaves us with 45,000 of additions over the annual investment allowance that we can't claim, so we must add them to one of the pools. Now, the written down allowance on the main pool is 18%, the written down allowance on the special rate pool is 8%, so it is more efficient for us to claim the 45,000 in the main pool, where we will get higher written down allowances. You can do it the other way around. You can put it wherever you want. You have the right to choose not to do what's best. But what is best is to put it in the main pool. The only addition we have left, which we haven't dealt with, is the emission car. Because it is a zero emissions car, it is eligible for a special first year allowance of 100%, and that is an addition of 35, not 350, but a claim of 35, which means an addition of 0. We've now dealt with all of our additions under annual investment allowance, under first year allowance. All of our additions have been put somewhere. We've been told that there is a disposal from the special rate pool of 16,000. Now the figure we use for disposals is the lower of cost and proceeds. Now cost, we can assume, is 25,000 or greater because we're told it's from this pool. Consideration is 16,000, so that's the figure that we will use. And we now have these totals. But we cannot have a balance on the special rate pool when we know that the asset that was in there has now been sold. So we must put either a balancing allowance or a balancing charge in there to make it 0. We need a balancing allowance. If this was a negative figure, we would put a figure in here to go that would be a negative here. To get this to 0, we need to claim 9,000 more capital allowances. This means we now have 0 and 76, and we are able to now claim our writing down allowance, the standard writing down allowance of 18%. 18% of this figure is 13680. And this gives us closing figures of 62320 on the main pool, 0 on the special rate pool, and 257680. We've dealt with all of the additions, we've dealt with the disposals, the balancing allowance, the written down allowance. We have now completed our capital allowance calculation. What this means is this figure is the figure that we are now going to put in our main calculation. So now we have our profits less our capital allowances, gives us 427,320. We add our chargeable gains, we take away our qualifying charitable payments, and that gives us our TTP of 448,270, and augmented profits of 455,770. Now that we are all using the same rates and the same bands, augmented profits is a near useless figure. The only thing we continue to use it for is to work out whether the payments of corporation tax are made on a quarterly basis. If this was bigger than 1.5 million, the company would have to pay its tax every 3 months. Or if it was a member of a group where we did 1.5 million divided by the number of companies in the group, that would be fine. But this is a standalone company. This is not bigger than 1.5 million. This company can just pay its tax at the end of the year as normal. At this point, we can calculate our corporation tax due. We do not use augmented profits for tax. We use total taxable profits. So the tax paid is 19% of this figure. That comes to 85171. That is the, let me just get the question because I've got the bits of paper here. That is the 16 mark part 1. This calculation with the capital allowances that feed into it. 16 marks for those 2 pieces of paper. Now the 2 at the bottom, which state when the corporation tax and corporation tax return are due, are just 2 statements. The year end of this company is the 31st of March. Corporation tax must be paid 9 months and 1 day after the year end. 31st of March 19 means this must be paid by the 1st of January 2020. It also means that the tax return, or the CT600, would be due 12 months after this date, which would be the 31st of the 3rd, 20. Those 2 little marks on the end are almost freebies. You just need to put them in there and you will get them straight away. This now is 18 marks out of the 18 available, 100%. The calculation of this has taken, let me just look at the clock, 14 minutes 55 seconds, so 15 minutes. As a 16-mark question, 18-mark question times 1.3, that is a 23-minute question in the exam. So we've just seen us go through it in 15. That doesn't mean you should be able to do it in 15, but it does mean that once you practice this enough and you know where it's going to go, you should be happy with doing it in less than 23. I'm going to do a separate video for part B of the question, because in this question we were given the chargeable gains, so we didn't have to calculate it. If we're not given the chargeable gains, we would just have another sheet here and we would do the chargeable gain, and whatever the figure was at the bottom there, that would come into here, and it would still be the same calculation to go through. But in this instance, we were given a chargeable gain. This part is separate and independent. Part B is a separate question on calculating a corporate chargeable gain. So I'll change the paper over, and then we'll do that second bit as well.